Good. Don't fight the Fed. Last year we saw this stock market wisdom once again. To fight inflation, the Federal Reserve raised interest rates to 4.5% in 2022. While interest rates are rising, the stock market suffered. The S&P 500 lost about 20%. The SMI also ended the year almost 17%. Especially growth stocks were hit hard. Tech stock, which had been the favorites of many investors in previous years, had dropped 17, 18, in some cases 19%. But not only the stocks dropped, also the bond market crashed. So-called balanced portfolios, which are 60% stocks and 40% bonds, lost more than at any time since 1927. This made the year 2022 a special one. But we are here today to look into the future, to look in 2023. Because that changes also open up new opportunities. And with that, welcome to our CAT Markets Outlook 2023. On the behalf of the entire CAT Financial Products, I would like to welcome you, and I'm very happy that so many people here join our live stream. My name is Przibylla, and I will guide you through this event today. But before I welcome the most important man of the day here on stage, one thing for organization. If you have any question during our live stream, you can ask them via the comment section below the video. I am reading along here and will place the question in the Q&A after the presentation of Maurizio and David. So now we are ready to go, and I'm very pleased to welcome our CIO here on stage, Maurizio Porfiri.
Thank you, Roman, for the introduction, and thank you for tuning in to our Global Market Outlook for 2023. As Roman already mentioned, it has been a bumpy ride, 2022, and before we start to go into the future, just to see where we're starting, what's the setup for this year's capital markets. We have to quickly review what happened in 2022. We will then focus on some global macro picture, how the economic numbers do look like, and we will then jump into the asset classes, which are equities, rates, commodities, and then finally some of our strongest recommendations or where we should probably not be in this year. Let's quickly have another look where there was no place to hide last year except of commodities. This chart shows that pretty well, that only in oil, WI crude, or in a variety of commodities, double-digit positive returns were able to be achieved. When we go down the line, it goes from 16% in bond markets down to the equity S&P 19.5 minus NASDAQ, the worst performing index. Bitcoin had its second worst return with roughly 64% minus. So this is the clear message in 2022 was cash is king. And with deposits rising, investors obviously prefer to stay in cash or put a lot of money into cash. And this is the important message. We are starting the year with a lot of assets have been moved into cash where deposits have been rising. And waiting for more visibility to be deployed again. Now, what has been mentioned on the globe on the portfolio basis, it's as well, if you look the single asset classes going back to 1871, the chart on the left, you see the red dot point, which shows that it hasn't happened in history that equities and markets have been down double digit in respect to the years following. So you see that most of the dots are for returns in the bond market between 0 and 5%, and equities rather between, let's say, 5 and 15%. This is the majority of the dots and years, but you see that we have been through an exceptional year. We have to keep in mind that for equities, it has been a very strong year before with central banks flooding and actually fiscal policies flooding the market with a lot of cash. Obviously, this has driven valuations higher and put into stock market a lot of money. But nevertheless, we think that a repetition of this is really hard to see. There is one scenario which could happen in this direction, but I think we are not on that camp, which I will explain later on. When we go back just on the S&P 500, rarely we have seen a back-to-back yearly double-digit drop with this magnitude. You see the red point is 2022. Only during the Great Depression we have seen in the 30s 2 years, one after the other, with double-digit losses. In between, we have had rebounds or the market going back into the normal distribution, which is rather between, let's say, plus 10 and plus 20%, where the most returns have been measured. What have been our predictions last year, and where did we land? What was the touchdown by year end? In equities, we had to revise our target by mid of the year or in Q3 because of a few happenings. We had to revise from 4,775 to 4,300. There we were still a bit above consensus, but considering the lows at 3,575 and the rally reaching 4,100 in December, we haven't been that far, respectively. And so, yeah, we have been close to the clients, telling that we are in this bear trend and there are bear market rallies. But again, we missed it by a bit on the year end. On rates, we have been quite accurate. Our prediction was for 350, 375 on the 10-year Treasury. We ended up at 388. This after seeing a 424 number in October last year. Commodities, pretty much spot on. 80 to 85 was our prediction, and we kept our energy bullish view despite the downturn in economic numbers. We always said that there is a demand-supply discrepancy, and we were favorable for the sector in commodities. We have upgraded energy already end of 2021, so we kept this overweight in this asset class. And finally, on gold, I have been a bit too bearish going into the year end. I have revised the target here from 1650 to 1850, $200 down. That was a bit too bearish, expecting that people are placing more money in treasuries than in gold. Now gold catched up starting the year, and I will come back on our predictions. Now, some economic numbers. Inflation, that's the enemy number one of the Fed. That's what they want to fight with actually considering a weakening economy or through a weakening economy. That's part of their plan. And we took the PCE, personal consumption expenditure inflation. It's a bit a different weighting of the goods or of the basket within there, but this graph shows quite precise where most of the inflation came from during 2021 and during 2022, and where we expect the disinflation is going to happen. So this number, which was at 4.7, we expect to decline to roughly 2.9% by 2023. We think that the most decline will actually be in shelter and supplies constraint, but as well in other goods, or let's say that's mostly our durable goods, where prices should start to ease off with energy costs, with the supply chains easing. And this is showed as well with the red bars, which are showing on the lower end of the graph going into the future. So a lot of the price increases were driven by the so-called supply chain disruptions. A lot of the chips did not arrive in the fabs. Used cars have been paid higher than new cars. All these imbalances slowly should start to decrease, and as well transportation costs, which have seen multiples of what we have seen pre-pandemic, are now back to normal, and this should actually get us to a disinflationary environment, which usually is good for risky assets. The magnitude, the speed, that's the question. How fast are they able to come down, and how much does the Fed need to tighten to get the number down? Healthcare and other services, including travel, stay high. Maybe if you booked your last flight tickets, you will have experienced that. Finding places in vacation is still very expensive. So there is in services a need to catch up from the pandemic. So we think that this is the sticky part. This is the part where inflation continues to stay high. Other services, this is your fitness or recreational costs. These are services you pay on a monthly basis. These things probably need a bit more time to cool off as competition maybe is less extended. We think that in the durable goods, competition is there, that price increases probably will not be continued and come down. Now, the main message here is how is the market reacting on any kind of news related to inflation and to the economic development. In Q4, bad news was good news. So the lower the number of the economic development, the more equity markets or risky assets were trading positively, because they were thinking that inflation is going to come down lower and that the Fed maybe has to tighten less. Now, this year, I think we have to be a bit more careful on bad news, that it's probable that bad news will be bad news, because we want to see or have more clarity on the magnitude of the downturn, if it's going to be in a soft patch, in a mild recession, or into a hard recession. So where do the economic leading indicator stops on the way down? That will be important in the next 2 quarters, which we will monitor very closely. And finally, if we went through the downturn, if the PMIs turned around, if things going to get better, then good news will be good news again, and we're going to be in an environment where actually markets should benefit from improving economic numbers. Now, let's have a quick look at the growth numbers. 2023 consensus growth expectations, Euro area slightly down with 2 very severe quarters ahead. This is what the predictions have been in Q4. Now, some of the strategists and economists are already taking a bit higher this number, because we have seen some positive development in the European PMIs. This may be due to the weaker euro, due to the energy crisis, which has been a bit less worse than feared. And in the US, still a positive consensus for the full year, but with 1 or 2 quarters with a negative GDP, which will be the big questions as well for our scenario. How long will it be? When will it start? And when it's gonna end? And we have, for this, we will draw 2 scenarios. I think it's we're not yet here to just only give you one scenario, because there are too many question marks ahead, or open question marks, which could give us only one scenario. So our base case scenario for the US is for a mild recession, which means 2 quarters with negative GDP, but only very little minus numbers, and let's say a normal recession, which I will explain on the next few slides. And I think to determine this is the big question: where do PMIs, or the, let's say, leading indicators, stop or actually bottom? We see that services PMI and manufacturing PMI still pointing down on the chart on the right. In the EU, as mentioned, we have seen a small bottoming that has led to some investments into the euro area just recently, starting December. But again, do they stop around 40 or below, or are we already see a bottoming around 45? And what will be the major drivers of these leading indicators? I think the Fed pivot still. What are the messages of the Fed? Are they going to stop at the pivot, or are they going to continue to tighten? It's energy prices is a big factor for inflation, for the costs, for the profits. And finally, the China question. Is China reopening? Are they actually stepping back from their COVID zero strategy, bringing back growth into the global economy? These are the main factors which will then decide about the outcome. Now let's jump into this recession question. Most anticipated recession. This is what how I call the headline. We're talking about this recession since more than 6 months, and for me, market is quite effective or efficient, and it tries to price in most of the news which we are seeing. And in this case, we have still a very large discrepancy between what the expectations of a recession are and the magnitude. Just to show you this chart on the left side, Powell's preferred yield curve model is indicating a recession probability of a bit more than 30%. The fixed income market, if you look at the 3 months 10-year spread or the 2-year 10-year spread, the probabilities range between 50 and 60%. And the Bloomberg economic indicator, or the recession model Bloomberg is taking, where there are much more indicators in there, we have a probability of 100%. So somewhere between here, we will have the reality. So I think it's not going to be zero. I think we're going to have 1 or 2 bad quarters, but the magnitude is the question: how far and how long it will be. Now, looking back into history, history tells us that 10 out of 15 recessions since 1920 have lasted less than a year. So if we expect a, let's say, normal recession without a tail event, without a major outside event which is pushing the growth numbers deep below 1 or 2%, then we could see maybe a scenario which we're going to draw down, which will be our base case scenario. And for this, we want to show you what has been the impact on earnings on the equity market first, on the S&P 500. So the impact on equities earnings in past recessions, real earnings dropped in average 15% from peak to trough. And here you can see that normal recessions, 1957, 1960, 1970, to 1991, the earnings peak to trough was below 15%, or let's say between 5.5 and roughly 16%. Then the 2 bigger recessions hit us. It was 2001 with the towers event, then 2009, the great financial crisis with the Lehman collapse and the effects on the banking system and the housing market. So these were certainly 2 exceptional years, or 2 exceptional recessions which have hit profits quite harder. Now, what's the situation now? Earnings expectations for Q4 point to a drop of 7.3%. So we are pretty much halfway done if we take the average of 15%. Now, if we exclude energy, the expected drop is already at 11.4%. Energy had an exceptional year. We saw that because obviously oil, gas, and commodity prices went through the roof, especially at the beginning of the year. But even if we take out this, if we take the whole picture, 7.3% is already a lot, but I think there is more to go. I think we will have Q1 and Q2 with some negative surprises, especially in growth related sectors. We will see earnings come down. There are some profit warnings still ahead, and probably this we will have to monitor already this Friday when the Q4 earnings season will start to kick off. Now, in average, about 4 months after recession, equity markets already started to rebound. So if this is the case, maybe this year it's a bit earlier because we are calling out the recession much earlier. So there is hope that we might maybe already have seen the lows in the S&P 500. And this is what we are going for our scenario. And I like to draw some projections for the S&P 500. You see that the red channel is the bearish trend, which we have been pretty much all 2022. Strong rebounds, bear market rallies, but then finally not making it to break out the bear trend and, making follow investors increasing their exposures, CTAs not increasing their exposure to equities or putting leverage into their models. So these were all still a lot of bear traps, bull traps, followed actually by bear market rallies. Now, what do we expect? I think 4,300 is a number which could be realistic for at least second half of this year. And what we could expect is that we have higher lows, that we are breaking out from the downtrend between, I would say, Q1 and Q2. I think the profit warnings still have to come. And then we would see a backing and filling around the 4,000 level and maybe then reach new highs going into Q3, Q4 and end the year with 4,300. Again, this is quite a prediction far out. I think we're going to focus on the first 2 quarters first. But again, I have a second scenario where the base case scenario only works out if we don't have major geopolitical risks, another escalation of the tension, if the pandemic is not going to go out. So I think this would be a smooth pass if we don't have any hiccups down the way. That's still realistic, but we have to consider as well that we are a bit walking on the edge with the Fed still increasing interest rates. And if something happens which would create a shock, then the second case could be a reality, which would mean a continuation of the bearish trend. We would make the Q1 and Q2 marking new lows, meaning revisiting 3,500 followed by 3,200. This would be the lower end of this range, and then probably ending the year more towards 3,900 or 3,600. All right, what does that mean for sectors? Dispersion has been very high this year, with the leading sector 60% in energy and minus 40% for consumer services. Usually this dispersion is around 60% between the best and the worst sector. Where should you place your money? I think energy should continue the lead. Although we are in economic downtrend, we think that commodity prices are not set up for a collapse, that we will maybe consolidate a little bit in these quarters where we see the downturn, but still probably end up the year higher. This is for WTI crude and for industrial metals. Then defensive cyclical sectors should outperform. Here we could imagine, or we think that industrials, financials still could be a good place for an investment starting the year. I will come into the details quite a bit later. Where we think there's a bit more pain ahead is the consumer discretionary and technology. Still actually have to, let's say, digest the downturn or actually for the consumer actually being able to spend less, and it's still a crowded long. I think a lot of people still have overweight positions in technologies, and this slowly has to melt, or actually has to be cleaned out. Now, materials could be the joker. If China growth accelerates and the US dollar continues to weak, which has started this year, this could be maybe one of the sectors emerging as a one that would show up in the top list by the end of the year. And again, quickly to our sector allocation, just to remind people, we have always 3 sectors on overweight and 3 sectors on underweight. We recently upgraded industrials. It was in November, lining out the reshoring theme, saying that a lot of industries try to get back their productions into countries where they're closer, where they are not dependent on political situations, where they can avoid a supply chain disruption, which we have seen during a pandemic, where they have control about their productions. And this trend is probably ongoing in 2023. A lot of capex is being built into new fabs in the US, in the United States, in Europe, especially as well, Germany being dependent from higher energy prices. They are trying to diversify their productions. And this means a lot of new orders for companies which are doing everything, which is built around with a company, right? You have to put the elevator, the cooling system, so the Honeywells, the Rockwell Automations, all these companies should have solid order books, even in a downturn. And there's another factor which is favoring these companies, is that their order backlog, because of the supply chain disruptions, are still quite big. So they might bridge the downturn with the order book backlog, which has been created during 2022, and then actually maybe have already bridged this into the next upturn, maybe by the end of 2022. So financials, we think the interest differential is the most evident reason for higher profits. If there's no credit problem, if things go smoothly with the economies around the world, then we could imagine that there's an outperformance in these sectors. Factors, we think quality remains our favorite factor. We think value is more likely to outperform in a hard recession scenario. So we think that companies with good earnings, solid balance sheets, growing dividends will make the lead, and we'll have some ideas regarding those companies down the way. Now, what's about Europe and Asia? Asia and Europe had a great start into the year, especially Europe silently made it out of the downturn. I think here the big drivers are the expectations for a weaker US dollar. They attract international investors because they could have, on top of the positive performance in the equity markets, an additional booster through the currency. So I think American investors started to look at Europe again, maybe being not so worse because there has not been an escalation. The war is still there in Europe. That still poses some question marks, but it's maybe not as bad as it has been feared in Q3 and Q4. So these the main reasons, and don't forget the sector composition, which is very favorable for the Euro stocks. We have more defensive names, a lot of industrials, there's energy, there's little exposure to growth stocks. And so that makes the Euro stocks in this kind of environment a good place for an investment. And China, obviously, it's all depending, are they reopening? When are they reopening? Here, obviously, the Taiwan question is not off the table, so high returns could be possible, but still coupled with a higher degree of risks. And if China goes big, remember this chart, exports to China as a percentage of GDP. I think we should look at the emerging markets as a whole, following this move, seeing Brazil having almost 40% of exposure to exports to China, then followed by South Korea, Australia, Taiwan, India, and even the Euro area has almost 5% exposure to China. So this should actually be a beneficial point in case China would emerge as a growth driver in 2023. Let's go to the rates. Pivot or not, I think at the minutes, Jay Powell said pretty clearly that rates are going to stay high. He wants to prepare the market that we're not expecting rates to come down in 2023. The chart on the left still shows that the market wants to tend to see a reduction in interest rates in 2023. So there is a gap between the expectations of the swap market and the dots of the Fed. That's normal. I think here we have, after these steep increases, the market might want to see a softening into interest rates, but the forward on the implied overnight rate futures model has stabilized around this 5% number. So the blue chart shows that already since a few months now, this forward has not moved, and this terminal rate of 5% by June 2023 looks to be a reality, and the recent numbers that have been published should not divert us from that expectation. But again, no rate cuts in 2023, and the first rate cut is expected in February 2024. Now, what does that mean for the US Treasury? We have 40 years of a bearish trend which have been broken. The breakout is evident. I mean, this is not questionable anymore. You see, we have made it last year, and this would actually mean that the era of higher yields are back. Now, how high these yields are going to be is still a question mark. Obviously, after such a breakout, there is room for stabilization, meaning that after this overshoot, we expect rates to first come down again, set the base somewhere in the area of 3 to 325, and this would as well match what happened in the past recessions, on the last Fed rate hikes, what happened to the 10 years. So usually between 1 and 4 months before the last Fed hike, the 10-year Treasury has hit their highest number. So if we have seen 424 in October, if that was the high, somewhere in Q1, Q2, we might see the Fed stopping increasing interest rates if that history is going to repeat. Now, people are questioning what happens with higher yield to the debt maturity, how are the bank loans, are there red flags in consumer credit, is the housing cooling a danger to the economy? We answer those questions with no, as far as we know now. We have the debt maturity wall, which will be beyond 2026, so 2023 shouldn't be a problem. 2024, they're increasing a bit, but before 2026, I think there are no big risks ahead. Consumer credit still soft with some savings, which are still around. They are melting down with the higher economic, with the higher inflation, but we are still not in a situation that credit defaults should start to build any red flags. Now, what we could see if the credit situation worsens, that we have a credit Fed put. They showed that they can do it during the pandemic. They started to buy high yield bonds to create liquidity. So this is an option that the Fed still could keep in their pockets. And now, is credit pricing in a recession? What are the credit spreads telling us? I think they have peaked for the time being in Q3, Q4. They are on the way down slowly. And what we have seen as well in the speculative investment part, that the default rate expectations already are pricing in a mild recession. So this model from BCA shows already that the dotted line started to price in a default rate of roughly 6% for the speculative debt, and this is not too far away from a normal recession. So if we take out the 2010 and 2000 recession, where default rates went 10 to 14%, we are rather in an area where the default rates look quite normal. Now, where should you put your money? The important message is we see good value in US high yield and in EU investment grade because interest rates probably have reached very attractive levels going forward, and maybe they're not going to rise much more than that. So for this, floored floating rate structures, which would keep you the door open for rates still going higher, but as well with credit overlays giving you attractive returns. To finish up the asset classes is commodities. Here, there's a blue and the red arrow because it's a bit tricky. We are now consolidating with economic numbers coming down. We had an overshoot. So it is possible that we have a sideways move. Maybe we go into a consolidation that could be 10 to 15% in the short term. But we think still that commodities structurally will go higher with the higher interest rate environment, with political tensions still on the table, with the energy crisis, especially as well in the energy sectors. A lot of underinvestments having been done in the last 10 years. So we think that those numbers should stay elevated if no hard recession is gonna happen. This would mean for oil 65 to 75 range in the first half year, but then moving back up into the 80-85 area as soon as the economic numbers are gonna improve again. Gold, here we have to rely a bit on the demand supply situation. Demand side increased hugely by central banks starting to buy gold. I think the main reason behind there, or the rationale, is to diversify from the US dollar, because they might expect as well that with a Fed pivot, the US dollar is going to weaken a little bit. The safety card played has been reduced a little bit. So here, if they continue to buy with this amount of numbers, we could see the range in a base case scenario around 1850 to 1950. But again, we're not expecting gold to go far above 2100, or if there is no hard recession or a reason for a risk off, where gold would be then as well bought for a security reason. So we still think that treasury rates are too attractive to actually being replaced by a hard asset or a safety asset like gold. And what could be a driver as well is China reopening and the luxury demand increasing again with Chinese consumer traveling and spending more money. Let's sum up what we just spoke. Base case scenario, again, mild recession, not a hard recession, with a year-end target which is possible at 4,300. In the equity area, we think Germany, Switzerland, UK and France could have the most upside because they went through a very hard 2022, and if the energy crisis is not worsening, that could be a big driver, and rates coming down a little bit, commodities being flat to 10% higher. And on those scenarios, we would like to now give you as well some ideas where and how to invest. And with that, I open the room for some questions and then hand over to David.
So, thank you, Maurizio. We have received questions for you. So, I will start with the first question we received in our YouTube channel. The question comes from Clément. Thank you, Clément, for the question. Do you think your 5 to 10 EPS revision scenario is already reflected in the S&P 500 valuations?
I think that probably these 5 to 10% are not in the market now. So this is what we have seen I think that there is more profit warnings ahead in certain areas, and you have to consider, if we take the S&P 500, 25% of the S&P is built by FANG stocks, and the FANG stocks are going through the hardest time what is regarding their profits. So I would say if we look at certain sectors, the 5 to 10% are already modeled in, but for the heavyweights in the S&P 500, there could be some more pain, and probably this is showing us that we might trade back close to the lows that we have seen, but not making new lows before actually then we can go and have again earnings stabilizing into Q2 or Q3 of next year or this year.
Thank you. And we received another question via email, and it's about the technology sector. and the question is, how do you see the big tech stocks? You have it on neutral in your overview, but when do you think is the right timing to get back to the tech stocks?
Yeah, I think tech has the hardest time to go through what is regarding earnings. We have seen really profits melting from multi-billion numbers to just in a few hundred millions if we take it from a cash flow perspective. So we have to keep in mind that the big capex which has happened and was fueled as well by the tech companies themselves. So taking a Meta, taking a Google, a Microsoft, they were actually spending billions into the industry, and this has to be scaled back. You know, we are seeing now the first layoffs, we are seeing capex being cut, and this has an impact. If you remember the earlier days when Cisco came out with a profit warning, this was a message for the whole tech industry, and today it's the Microsoft, it's the Google, it's the Apples. If they say they're going to cut productions or they have to just scale down a little bit, that's the impact for the whole industry. So the answer to the question is, I think we have at least another 2 or 3 quarters of pain that they have to go through, and it depends how they react and how do they adjust their costs. And they had their wake-up call. We saw Mr. Zuckerberg saying, "Oh, what happened here?" You know, they got surprised a bit on the left foot or the wrong foot, and now they have to react. And depending on how much the reaction is, it's probably between 2 and 3 quarters before then tech can start to move again. And there's an important factor: tech is still very strongly coupled to long-term yields. So where the 10-year yield is going to end is be a big question, or actually a big driver, if tech can find the bottom where we are now, or actually maybe moving higher or lower.
Thank you, Maurizio. Once again, really great to hear you and to see your outlook for this year. Thank you for that.
Thank you very much, Roman. Thank you. Thank you, everyone, for joining us.
And now let's talk about investing. How can we put Maurizio's outlook into practice and translate it into concrete trade ideas? For that, I'm very pleased to welcome David Schmid. The stage is yours.
Thank you, Roman. Good morning and a very warm welcome from my side. I'm very pleased in the absence of Maxime Prince to try now to translate what we just learned from Maurizio Porfiri into concrete call of actions. Starting on the credit side, I think what we just learned is that credit yields are still very attractive. If you look at the 3-year average, we are still well above this 3-year average, both for the iTrex crossover as well as for the iTrex main. So that's the first observation we have. The second one is what we just learned: the debt maturity wall is beyond 2026, and the bank loan books still don't show excessive risks. So I think it's safe to stay invested on the short-end side, even for the high-yield credits. And the third observation I would like to highlight is what Fed clearly said: they will continue to fight inflation with rising interest rates. So it's safe to assume that this will be the case for the entire 2023. Obviously, that has an impact on the bond market side. Therefore, we advise to stay rather on the shorter duration side. So these 3 observations, to translate it into a product, we can see on following slide. We are able to offer you principal protected credit linked notes with coupons at risk on single names. Again, short maturity, 1 year, lifetime, denominated in euros. The beauty about this concept is to take high yield credit names, but not to have the investment amount or the capital at risk, only the coupons at risk in case of a default of the underlying credit. So if you look at these examples, Petroleos Mexicanos, 5.26% coupon, Thyssen Group 5.23, CMA 5.18, and so on. If we compare that actually with a traditional credit-linked note where the capital is at risk, one can observe that the coupon difference is rather low. So therefore, again, in combination with what Maurizio has said, I think it's a safe instrument. And if we compare it with the 1-year swap rate in euros, there is a nice pickup of roughly 2%. Same, one can play this view on the iTraxx main series 38. Same concept on this one, with a rather longer maturity of up to 3 years. If you look at the coupon levels here, it's in dollars 5.6% and in euros slightly shy of 4%. Here, the same concept on the coupon side. Capital is protected. Coupons are at risk. So for every coupon, for every credit event, the coupon is reduced by 25%, meaning that if you have more than 4 credit events of the iTraxx main, the coupon would be lost. Moving on to the gold topic, what we just learned, I think it's tremendous of how much the federal banks have increased their gold reserves. So only China in the Q4 last year, you saw an increase of 32 and 30 tons. Turkey, similar picture, very big increases. And I think overall, it's very, very impressive how one can observe how the central banks have accumulated their reserves on gold. I think it's the fastest pace in living memory. 400 tons alone in 2023, which is the equivalent of 20 billion US dollar. I think it's a huge amount, and the most in over half a century. We believe that this is a trend which will continue, again, to diversify away from the US dollar. Therefore, we are happy to offer 107% principal protected note with shark fin feature. So 2-year maturity on the GLDUP underlying with 100% participation on the ETF up to a barrier level of 131%. This is the equivalent of 2,450 US dollars on the gold price. So I think it's a safe way to benefit from rising gold prices. And to the extent that the barrier would be breached during the lifetime of the product, you have at least 107% of your denomination back. It's slightly shy of the swap rate on a 2-year basis. So even here, I would say very attractive terms to take a view on rising gold prices. Another way how to play the rising gold prices is by investing through gold miners. I think Goldman Sachs just recently lifted their price target on gold miners by on average 7%. I think a way to look at this is typically that obviously rising gold prices have an impact on the profitability for the gold miners as well. So if we are translating that into a product, we are offering auto-callables on gold miners. This example here, Barrick, Goldcorp, Kinross, Newmont with an 18 months maturity. Auto-callable on a quarterly basis starting after 6 months at 100%. You can see the guarantee coupons ranging on the European barrier side, depending on the currency, between 12.7% in Swiss francs and 16.7% in US dollars with a barrier level of 65%. And if we are looking into more in investment with a continuous observation of the barrier, so an American barrier, at 55% offers you coupons ranging between 14 and 18%. For investors that do not prefer European or American barriers, we are also able to offer low strike auto-callables. So if we set the strike at 75%, you still get attractive double-digit coupons in the area of 10% in Swiss francs and 13.9% in US dollars. Next topic. So as we have learned from Maurizio Porfiri, the bond market suffered one of its worst years in decades. we have seen 7 times an interest rate hike by the Federal Reserves only in 2022. So the obvious question is, will there be a strong coming back of the fixed income market in 2023? Our view is clear here. We believe that there are exciting opportunities to invest into the bond market after such a drop, especially if one is expecting that falling inflation and a lower growth environment, which is exactly what our CIO has just mentioned in his predictions for 2023. Call for action here. I think the beauty about this is to benefit also from bond repacks, where you can benefit from illiquidity premium and at the same time structure it in the preferred currency and coupon frequency of the investor's preference. Here a nice example from Citi. The pickup of the illiquidity premium is 72 basis point versus a straight bond from Citi. Again, maturity 2025, rather short, denominated in euros with a fixed coupon of 4.08%. Again, if you compare this with the swap rate in euro of 3%, it's a nice yield pickup. Another way to benefit from not from rising interest rate, but actually from boom in the fixed income space is to play this with outperformance on the upside on bond funds. We have 3 examples here: PIMCO fund, Mucinich fund, and the JP Morgan fixed income fund. Depending a bit on the maturity you choose, you can get nice participation rates ranging from 18 months around 100% up to 140% on the PIMCO fund on the 3-year maturity, while your principal is still fully protected. So worst case, you get your denomination back at 100% at the end of the maturity. Best case, you are having the full upside performance of the underlying fund, and in some examples even with a small leverage on the upside. Obviously, we're very happy also to show this on your preferred bond fund, so don't hesitate to contact us would you like to see some variations on specific bond funds. Moving on to the equity market. Today is the 8th trading day in 2023, and I'm very pleased to see that on the equity side we have seen a very good start into the year, while volatility levels have been falling across the board. Just looking at the market this morning, we now see that Euro Stoxx is roughly 6.5% up year to date. SMI is roughly up 3.5%. Similar picture on S&P. So I think it's a good start, and that makes me obviously very positive for 2023. Nevertheless, we remain cautious on the equity side. Therefore, our recommendation, as we heard it from Maurizio, is to select quality stocks. Now, what is the definition of a quality stock? Number 1, it's high and reliable earnings. Number 2, a low level of debt. Number 3, conservative leverage. And finally, number 4, steady growing dividends. So if we use these 4 criteria and we use it and we apply it to our preferred sectors, the outcome is that stocks like JP Morgan Chase, Zurich Insurance, United Health Group, Johnson & Johnson, Honeywell International, and Schneider Electric are our preferred stocks. So how to play that in a call of action? Here, an auto-callable on quality stocks. 18 months maturity, we selected JP Morgan Chase, Zurich Insurance, and Schneider Electric with guaranteed coupons, again with auto-call frequency on a quarterly basis, starting after 6 months. You can see now with European barriers at 70%, again double-digit coupons, starting in Swiss francs with 9.95% up to 13.3% in US dollars. And for more risk-taking clients, American barriers at 60%, ranging the coupons between 10.7% and 14.1% in US dollars. And finally, also something which is very exciting to observe. After a decade of struggling for European banks to keep up with US banks, finally we saw a very positive signals from the European banks, making good profits and benefiting obviously from rising interest rates. We have seen alone in the second half of last year 3 interest rate hikes. So the interest rate difference business for the banks is booming and helping a lot. Even if the transactional business is being reduced due to investors being more concerned. We believe that this is a trend that will continue for European banks. So what we are able to offer is an auto-callable on Eurostoxx Banks Index. You can see the composition of the index on the right-hand side. Selecting a 12 months maturity, again with an auto-call frequency on a quarterly basis starting after 6 months. You get guaranteed coupons for European barriers at 70%, ranging from 5.5% in Swiss francs up to 9.4% in US dollars. And if you are selecting an American barrier at 60%, you get coupons ranging between 6% in Swiss francs up to 9.9% in US dollars. Obviously, these are just some of our ideas. We have a full range of trade ideas almost on a daily basis on all asset classes, also on cryptos. So please don't hesitate to reach out to us for feedback, for price variations, or for other ideas, both on the long and short end side. Thank you very much. And with this, I hand back to Roman.
Thank you, David. Great to see that we have this year so many opportunities. I don't know when I start a new year with so many options on the table, equities, fixed income, gold, and also on the product structure side, we have capital protection, yield enhancement, and so on. So everything is on the table. You have the choice, investors have the choice. And as David already said, we are here for you. Just call us if you need variations or if you need daily new ideas. And also we have a Telegram chat, which I want to recommend you here because this is a capital markets chat from our CIO. Just get it in the presentations, a QR code, just scan it and you can also join our Telegram chat. So with that, we are at the end and thank you for your attention. If you have any question, feel free to ask in the comments below the video or just send us an email or just give us a call. So we are always here for you and look forward to a great year with you. And with that, thank you. Thank you for joining the live stream and hope we get in touch. Thank you and bye-bye.